Welcome to FYI TV. My name is Sean Cook, and we got a great show for you today. Now, you know how all this Uber has reinvented taxis, Airbnb has reinvented hotels, all these different amazing technologies, and millennials and all these creative people are changing the world that we live in. Well, today we are going to be talking with David Szymanski with US Mortgages, and he's going to be telling us how he's reinvented the mortgage business. Dave, good to see you, mate.
Yeah, thank you, Sean.
We have got a show for you. We've got so much stuff to talk about. We can't talk about it all. We were talking off camera just now.
Yeah.
We're going to talk about three things.
Okay.
David, you know about it, not me. I'm just getting educated. What are the three things we're going to talk about today?
Well, I know you wanted to bring up our Homemade Simple product. It's a unique product that we have right here in Colorado.
The Homemade Simple.
Yep. Right. You also mentioned that you really love the fact that we reach out to help people going through tough times with our divorce resolution refi.
Right.
And last but not least, you wouldn't let me stop talking about our equity guarantee that goes for both a new home purchase as well as a refinance.
And folks, this is the one that blew me away. We were talking off camera before we shot this show. I don't know much about mortgages, but we're going to find out a lot more today. But this is a product that will ensure you from getting, from losing money, right? From losing money in your house.
Yeah.
So we're going to save that till last. Now, the first one we're going to talk about is the...
Divorce?
No, the one before that.
Homemade Simple?
Homemade Simple. Now, okay, nobody in the audience knows what Homemade Simple means. You know what Homemade Simple means? No. Homemade Simple means what, David?
Homemade Simple is our product that's designed to, take the fear and the mystique of buying a home from people that seems out of touch, out of reach, and make it reality, make it simple, make it tangible, and take it from that, I don't think I could ever do it, to I can't believe I did it. So one of the big misnomers is, you have to have perfect credit to buy a home. That's not true. Right. Another big thing is I have to have down payment.
Hold up. 720, 680. I mean,
all those are great.
What's a minimum? Well, you're not going to talk to somebody unless they. I know.
Yeah. People have challenged credit of all types. It's more than just the credit score. Credit score is important, and it is a piece of the puzzle. Yeah. But there's underlying risks. So there's things that a borrower may have that offsets it, so it's not just score alone. Like, we've done purchases for people down to 530s and 520s.
You've got to be kidding me.
No.
Because I was told when I looked at refinancing my house, if I didn't have a 720, forget it.
Yeah, no.
David, that's what I was told. I believed it.
Yeah, well, there's a lot of people out there with bad information, and there's also a lot of people out there with the only information they have being what's dictated by the company they work for.
Right.
So maybe that company said, hey, we're not going to accept a loan unless this borrower has a 720 or above score.
So it's called Homemade Easy.
Homemade Simple.
Homemade Simple.
Yeah.
Okay.
Yeah.
So folks, Homemade Simple, what that means, and I'm just going to sort of as the layperson explain what I think it means. It means that you can buy a house and you might not realize it.
Yeah. Yep.
Because when we were talking off camera, you mentioned you could actually borrow the money to put down on the loan. Is that correct?
Close. It's half correct. We've got a product inside of Homemade Simple that allows for up to a 5% grant. Grant is the key word here, because it means you never have to repay it. So we can not only help you get the loan, there's some government agencies, there's some product out there that allows or affords people that know where to go to get it, to get down payment money for their home, and depending on the credit and the income and the debt to credit income, debt to income ratios, et cetera, they can literally get the down payment given to them. So not only are they buying a house.
On a $500,000 house, you're talking about
up to $25,000.
I didn't know this, David.
Yeah.
Wow.
It's pretty amazing.
That's basically, and I don't want to say free money because there is no such thing as free money, but it's a grant that you don't have to pay back.
Correct.
That you can apply towards your down payment.
Correct.
So you got 5% down payment, and you add that to whatever you've got 5%. Now you've got 10% down on a loan. Now, what does that mean if I come to you with 10% down?
Okay. On that piece, I'll correct you. On that, we're assuming that you don't have money for a down payment.
Okay.
So we're getting that grant money assigned to you to make sure that you don't think that the American dream's for everybody but me. Right. So now I've got good credit, I've got a good job, but I can't get ahead. Let's face it, in Denver, most all of Colorado, it's expensive to live out here. So even if you're making good money, you may have $1,500, $2,000, $2,500, $3,000, whatever that number is going out for your rent, your utilities, toss in a car payment, maybe some student loans, maybe some credit cards. You may make good money, but while you pay your bills on time, where are you going to set aside $1,000 a month for the next 2 years to come up with $24,000 for a down payment, or $500 a month for the next 2 years to come up with $12,000 for a down payment? It's difficult. So what this does is it takes you, me, somebody that may not have the down payment money, and now let you qualify to buy your piece of the American dream.
Wow, folks. So if you didn't think that you could buy a home, please go to usmortgages.com.
Yeah.
Is that right? Or
Yep.
call the number on the bottom of the screen.
Yep.
Now, there's some tools you have on your website, because I looked at your website before this shoot. There are some tools you go there, and it doesn't cost anything. Just plug it in.
Correct. Yep.
You may be a candidate, and you don't realize.
Yeah.
Because is it better? I mean, there's a different school of thought. Is it better to buy than to rent?
Oh, by far. First of all, in the last 5 years alone, Colorado's had, on average, 53% appreciation. Now, that's not just a number, that's real. So think about that.
Right.
So let's say you bought your house for $300,000 5 years ago.
Right, $300,000.
Got a pretty nice house, you're probably in a pretty decent area. Fast forward to today, that home is more than likely worth somewhere between $450,000 to $475,000, and it could be more because 53% is the average. Some people may be a little less, some people are higher. Significant amount of 5 years.
In 5 years, you basically, your equity's gone up by $300,000.
Depending on the purchase price. So if it was a $300,000 home when you bought it 5 years ago, you're looking maybe somewhere in the range of $450,000 to $500,000. So you're talking about $150,000 to $200,000. Very real. Those are
folks,
real numbers.
What I'm picking up here, and this is making me sort of very passionate about this, is the people out there who are not buying could be missing out on wealth. And what's going to happen, this separation of the rich and the poor is just going to get bigger and bigger. So if you can get in there and buy a place and see that kind of growth, 53% a year. 53%
in the last 5 years. So basically it's about almost 11% per year.
So David, you're telling me 53% growth in the last 5 years.
Yep.
So on a $300,000 house, you're talking about 450, 500. So folks, pick up the phone right now, because you're missing out. There's people making $200,000, $150,000. That's only a $300,000 house. A $500,000 house, you're talking about $250,000. You can't save that kind of money. That's how people build equity.
Yeah, it really is how you build wealth. And the crazy part about that is when you think about that and you do the math behind it, I mean, it literally is like taking $1,000, $2,000, $3,000, $4,000, like on the example you just mentioned, a month, and add it to your portfolio.
Right.
It's crazy. And to be sitting on the sidelines, thinking you can't do it, not be willing to try. We don't charge anything, so you're not going to get hit with any consultation fee. You're not going to get hit with any, I met you, I have to pull your credit report, I have to see if you qualify. None of that. So the only thing keeping somebody from finding out if they can buy a home is not calling or not going online.
Well, and it's a win-win for everybody.
Yeah.
Right? It's a win-win for you, because you sell a mortgage out of it.
Yeah.
It's a win-win for the customer, because they actually buy something that is increasing by 53% every 5 years, if I'm getting you right.
Yeah, that's what it's been for the last 5. You know, you don't know where it's going to go the next 5. But, you know, one of the pieces of that is I've heard the stories and the things about people saying, well, you don't know where the market's going to go and you can't always predict the future from the past. That's fine. But we've got a product that'll protect you on that too, so there's no risk and no reason not to do something now.
Well, right now, folks, we're going to go visit with one of David's customers who's going to tell us how they built equity over a period of time, and they didn't think they were going to be a candidate. Watch this, folks.
Once I got the email from Alex that said, you know, this is what you need to do to qualify. You need at least a 620 or above credit score. I knew I should be in the ballpark for that.
And please do yourselves a favor, go to the website, usmortgages.com, fill it out and see, because it's not necessarily you've got to have a 720 or you can't talk to David. right?
Correct. No, we help all credit. We'll work with all incomes. We're not going to just carte blanche tell somebody no. We're going to put you, even if you don't qualify today,
Yeah.
we're going to put you on a plan and a path of what it's going to take to get you to where you will qualify to buy a home as fast as possible. What we don't control is how engaged you are. How much do you really want to do this? Now, I can give you the roadmap and say, to get from here to here, this is the move you got to make.
Right.
But I can't make you move. So some people we show they could get into a house in maybe a month, maybe 3 months. The next customer that is in that same
So
scenario
you're saying
might
that
take
you
a
can
year.
actually, okay, so you don't just take the customer or the person who's watching at home who comes in to talk to you. You don't just take them at face value.
Right.
You can actually say, okay, here's a program
Yep.
whereby in 3 months' time I can get you to qualify by doing. I mean, so how do you do that?
There's just, it's understanding what all makes up a mortgage loan, what all makes up the qualifications to get inside of the mortgage, and it's multifaceted. So you can't just look at score. You can't just look at income. You just can't look at the type of employment and the type of debt you have, because everybody's is a little unique. Just like you look a little bit different than I do, we're still male human beings, but we've got some differences to us, and that's the same way a credit profile is. It's almost like a fingerprint might be a better analogy. Everybody's is unique. You're not going to see the exact same profile on two people.
Right.
And what it does is gives us the insight that we can look at all the facets of the loan, how long you've been on the job, what your credit looks like, if you've had problems in the past, how far in the past, even if it's in the recent past, like in the last month or two, okay,
Right.
It is what it is. You talking to us isn't going to change you missing a payment. But what it will do is it'll allow us to look at it and give you the insight of, don't beat yourself up over this. Here's what the delay is going to cost you. Here's what you can start doing in the interim. And here's where you can be in 3 months, 6 months, 9 months, whatever the case may be.
Now, does it make a difference the fact that it's your money that you're lending, as opposed to you having to conform to the rules as a broker and everything else? I mean, this is, you've got to believe in the loan.
We do,
because it's your money.
we do believe in the loan, and we believe in the borrower, or we wouldn't make the loan. Part of your thing is correct. It gives us a little latitude. It gives us affordability to sometimes make a decision that somebody else may just say no to. But at the same time, we still have to conform to the underlying guidelines of the Fed. So where if let's say Fannie Mae comes in and says, we won't let anybody do a loan with us that's had a late mark in the last 6 months, and we wanted to get your loan through the Fannie Mae product, then I'm going to be stuck to that 6 months.
Right.
But even let's say you had your late mark and it was last month. Now we can look at it. We can assess, why do you want to be in this product? Maybe there's one that'll allow me to have one time late in the last 6 months,
Right.
and you don't have to delay. Maybe that isn't an option, and because what you want has to be just perfectly crystal clean credit. And so now by clean, we're talking about a 12-month history under most circumstances. So let's say you had that late last month, and you want a big amount of cash out, or you want to do a home improvement, or whatever it is you're looking for. We can go, all right, I can't do this until this time. And I'll just use now for example, and if we're into December and we're looking at, I had a late in November, I got to be all the way to October or November next year before we can do something. But we can also give you the roadmap of things to do and not to do, so that when that piece hits its proper age, your loan's going to sail through like a warm knife going through butter.
Well, we've only got a half hour here, folks, so we cannot explain the whole thing. But I can tell you this, nothing's going to happen if you don't try. So
Fact.
please, let's go to the website. We're going to take a quick break right now. We're going to be right back. Stay tuned. We've got a really revolutionary product. The man who is the Uber of the mortgages company, an amazingly creative man who has figured out a new way of doing business with mortgages to help you, to help him. Because just to clarify, when you get a mortgage with US Mortgages, you're borrowing the money from David
us.
Szymanski.
Yeah. Yep.
We'll be right back. Welcome back to FYTV. Thank you so much for staying tuned. We've got more information coming up, and I know this is a very kind of a weird subject to talk about. We're going to have to talk about divorce, mortgages and divorce.
Yeah.
And I hate to bring it up, but over 50% of people get divorced.
That's fact.
And I was thinking about it actually before we came in, and that's 50%. But what about 50% of the ones that already got divorced? It's actually maybe higher.
Yeah.
But anyway, David Szymanski has come out with a concept of how to get out of divorce without the gnashing of teeth and the attorneys and the everything that usually goes with a divorce. You've got, what do you call it, David?
We call it our divorce resolution refi. You're already going through a split. You're already in a very uncomfortable and
Right.
for lack of better terms, probably potentially nasty situation. Even
Right.
if it's an amicable split, you're still talking about splitting apart the family, splitting apart the equity.
It's a minefield.
traumatic.
It's a minefield. You're stepping,
Absolutely.
and part of it I know for a fact, because
Yeah.
I have actually unfortunately been through a divorce,
Myself.
is trying to deal with the nuts and the bolts. Okay, we've got both of us on the deed of the house,
Yep.
right? Somebody's got to go. Who leaves? I
Yeah,
mean,
you
how does it go down usually?
Yeah, you got a couple options at that point, depending on the wherewithal of the borrowers.
Yeah.
Maybe one can afford to stay there without income from the other one, and if that's the case, whether it's it doesn't matter who it is, whether
Yeah.
it's man, woman, partner, whatever, you can have that to where okay, I'm going to stay on the house. Well, what happens to you? So now, if I'm staying on the house, now I've got to figure out how much equity is in there because your attorney's going to want to know. My attorney's going to want to know. The courts are going to want to know what is a fair and equitable split.
I wish I had known you 7 years ago. Because guess what happened? Okay, this is my scenario.
Yeah,
I was, took the high road. I left.
yeah,
I just lost all the equity in the house. All of those weekends I worked on the house,
Yeah.
everything. I just walked away.
your down payment, the appreciation.
I got absolutely nothing.
Yeah.
Then I got taken off the note,
Yep,
which was part of the divorce process.
Sure.
Meanwhile, I've been struggling. My credit was not as good as I would like it to be.
Sure.
It took me 3 years of renting before I could buy somewhere. And you're telling me with what you're doing, you can sew it all right up there and then, and the spouse, the leaving spouse, whether it's the male, female, male, whatever it
Yeah,
is, the
yeah.
person who's leaving
yeah.
can walk straight into owning a home and not go through 3 years of.
Yeah, because if you do it right, one of the things is you're going to have to get a valuation of your assets. Well, if you've got stocks, bonds, income, that's easy. I mean, you're looking at a piece of paper, you can see what the numbers
Right.
are. But with a home, that's a little bit more of an intangible. So they're going to want to get that better defined. They're going to need an appraisal on it. So since you're going to remove somebody off title, and this is under the premise of somebody's going to stay in the home,
Right.
you get the appraisal. Now that appraisal, if you've got that done through us, that's valid for any court. That's valid as a fair and accurate representation of the home is worth.
Right.
And so I'm just going to throw out a number. Let's say it's $500,000 or $300,000. Whatever you owe on it that's below what the appraised value is, that difference is the equity. And so let's call it $50,000 is the equity in the home. So now you want to stay in the home. You want to get me off the title of the home. We do the refinance. We've got the proper valuation that's accepted by both
David,
parties.
I'm liking you more and more. So you basically come in there and say, here you go, here's 25,000, here's 25,000,
Yeah.
and you fix the problem.
Yeah. And then what happens is you stay in your property.
Yeah.
I leave with 25 grand for a down payment to go buy what I want to.
Right.
And as an added benefit, because we know you've got tons of expenses with attorneys and court
Right,
costs and
right.
the division of assets, et cetera, we extend what we call our lifetime origination benefit. Like as if you've done a loan with us once in the past, we don't charge you again for all the lender fees.
Okay.
We extend that to the person or both parties going through the divorce, even if they've never done a loan for us. So you won't pay origination, you won't pay for your
All
processing,
of those closing
underwriting.
costs, all that stuff, the hidden costs that always seem to be built into a mortgage. It's
Correct.
always, do you pay it or do I pay it?
Right.
But it doesn't exist.
Correct.
Wow. I hate to say it, honey, but moving to Denver's looking better. Can I just, I'm getting the wrap up from my cameraman, but
Yeah.
before we go to break, can I just clarify this, that I could get divorced,
Yes.
get the equity out of my house,
Yes.
move to Denver, you could help me get a loan, right?
Yeah.
One way or another, and I think that's what I'm hearing from you. Is you've got
Yeah.
a commitment to get. It's not just like, well, you're going to one way or another, you're going to get me a loan.
Well, you got to still qualify. That's the piece. So, like, let's say your scenario that you just laid out there. If your ex is going to be
Hang on a
back,
sec, honey, if you're watching this, I'm just kidding.
That's funny. So if she's got a good job and she can afford her house,
Yeah.
then yes, that exact scenario you laid out could absolutely work.
Oh, she's got a much better job than me.
So she could wind up staying in the property, qualifying for it. Your equity comes to you. You come out here, and then yes, you've got your nest egg. You've got the ability to put a down
Well,
payment
in
down.
all honesty, I wish I'd known you 7 years ago.
Yeah.
Because it took 3 years for me to recover from that. And you're
Yeah.
saying that you could have seamlessly
Yeah.
walked from that's an amazing, amazing solution to a problem that I'm not saying I agree with divorce. I think it's very sad. But
It is
if
sad.
you can come in there, if David Shemansky can come in there and broker a deal that makes everybody a little happier and doesn't send a whole bunch of money to the attorneys so they can fight over this stuff,
Yeah.
I think you're the man. And we're going to have to take a quick break. When we get back, people, we're going to be talking about a way to insure your equity, which I believe is only offered by David Shemansky. Is that correct?
Well, only offered by U.S. Mortgages. That's correct.
In this market, and
Yep.
just to tell me, just what and why is it only offered by you?
Because when I first heard of the concept, I jumped all over it and I said, this is absolutely fantastic, and I will pour money into it, provide it out, and make it exclusive so that if you want to do a loan, you want to protect your asset and your equity, do that loan with us, and we give it to our borrowers.
And what's the name of this one?
It's called Home Safe Equity Guarantee.
Home Safe. Okay, I'm going to recap just for a sec because I don't have the best memory. The first one,
Homemade Simple.
Homemade Simple. So
Yeah.
we've been talking about Homemade Simple.
Yep.
Okay, that's basically dumb.
A way to buy a
simple,
house.
Stupid, a simple, stupid way to buy a house.
Yeah.
You can just go in there and that it comes with a lot of resources to get your credit score better. Come up with a plan. If you don't qualify now, you qualify later.
Sure, and not only help you qualify, gives you access to grant money for the down payment of your home.
Right.
And as one added perk and caveat to that, if you use the realtor group that's already signed up with us, they'll give you a 1% cash back at closing to help pay your closing costs and or help just have extra cash when you move or help pay
Right.
moving expenses.
Well, I'm going to wrap it up for my cameraman. Folks, stay tuned. We've got one more section left. In fact, we're going to talk to a realtor next when we come back from break, and then we're going to come back and talk about this
Home Safe Equity Guarantee.
I'm liking it. I mean, what I've found out so far is just amazing.
Yeah.
And, we're not obviously trying to encourage people to get divorced. I mean, I could see
No,
somebody
no,
right
not
there
at
being,
all.
well, I was going to get divorced, but I didn't want to. And then we saw this infomercial on TV. I said, man, and then the wife's mad with us. But you know what? Even in that scenario, she may be happy. She may be happy. I get to keep the house. He's gone. I had to put up with his stinky ass.
Yeah. Well, hope that's not the case, but yes, if you are going through a bad time, we can at least make our piece of it a little bit easier.
All right, folks, stay tuned. We've saved the best till last. Don't touch that clicker. We'll be right back. Thank you for staying tuned to FYI TV. We're here with Josh Hastings, a realtor, and we've been talking with David Shemansky with US Mortgages about the mortgage side of buying houses in Denver. And now we're going to talk about from the realtor perspective. Josh, tell me, why is now a good time to buy in Denver?
Well, thank you very much, Sean. Right now is the best time to buy in Denver that we've seen in over 48 months. Several contributing factors to that, but what we're seeing right now is a small dip that we expect to see a nice bounce back this spring with, giving our buyers an opportunity to grab equity now and save themselves 5, 10, or 12% purchasing now than later in the spring or summer.
Well, I remember those stories when, a house would go on the market, all of a sudden you'd have two buyers, immediately they'd start bidding it up. It was a bad time to buy. There was too much inventory. There was not enough inventory on the market.
That's correct.
Now, what you're telling me is that you can go in as a buyer and buy stuff and not have to bid it up, maybe even bid it down.
Absolutely. So in the last 3 years, I've been able to place over 150 families into homes.
Yep.
During most of those 3 years, we've had to pay over appraised value, right? We've had to pay more money than the home was worth. We've had to take no seller concessions and even have a hard time getting anything back on inspection. Now we've entered a small little blip in the market where we are seeing the fact that we can get houses under ask. We can get seller concessions and we can get those pesky inspection items fixed for them before they move in.
Josh, I think I understand what you're saying. What you're saying right now is there is more supply, i.e. more property, than there are buyers. So it's a good time to buy. But in the spring, there's going to be more buyers than property. Is that, am I stating that correctly?
Absolutely. That's what all the market conditions show us, and that's exactly what's happening. Right now, we can get you into a home with conditions that exist that didn't exist 3 months ago, and probably we won't see 4 months from now either. So this is the optimal time to buy
Yep.
to maximize your dollar.
Okay, folks, so now is the time to pick up the phone. The phone number's right there, the URL's there. Now's the time to buy. You want to buy low, sell high, right?
That's absolutely the plan. Thank you.
So it's a great time to buy, folks. Now let me ask you another question. US Mortgages is a great company. You know that, I know that, but can you please tell the audience why you think they're a great company?
Absolutely, Sean. So many mortgage opportunities, so many different companies in this town. But when you find someone that works and consistently outperforms your clients' expectations as well as your own, that's someone you stick with, and that's been the case with U.S. Mortgages.
Well, you're kind of symbiotic, right? You can't sell the house without the mortgage. The mortgage company can't sell the house without the realtor. So you guys have to work together. And just a scale of 1 to 10, how would you rate U.S. Mortgages?
Absolutely. That relationship is absolutely paramount for success for our clients, and clients are always first for both of our companies. So I'd rate it a 10.
All right, folks, you heard it from Josh Hastings himself. Now is a good time to buy, just like David Chemansky said. Stay tuned. This next section, David's already kind of spilled the beans about this a little bit, but it's a way of protecting the equity in your house, protecting the down payment in your house, so that even if the market goes, whew, you're going to be okay. Stay tuned. Don't touch that clicker. We'll be right back. All right, folks, thank you for staying tuned. My name's Sean Cook. This is FYTV. We're here with David Chemansky, the guru of the mortgage business with U.S. Mortgages. And David, you've got one more thing left.
Yeah.
David's got a million things. We're trying to put 50 pounds into a 5-pound bag, and I've been
all right.
trying to reel him in. Just
Yeah.
3 things.
Yeah.
You got a million other things, I know. But in
Yeah.
this half hour, we're talking about 3 things.
Yep.
We've talked about
Homemade Simple, help you buy a house.
Yep.
Talked about divorce resolution refi, help make the very painful time a little less painful.
Right.
And then, as you call it, the best for last, the Home Safe Equity Guarantee.
Home Safe Equity Guarantee.
Yeah.
David, what is that?
Okay, well, in a nutshell, think of it like this. You had mentioned at one point, how would you insure a stock portfolio? You can't.
Right.
How would you have anything that's an appreciable asset or an investment as a stock is, as a home is, and guarantee its value?
Well, it's a gamble, right? I mean, buying a home is a gamble. It's just like,
It used to be. It's not anymore. Denver's known historically, and most of Colorado is known historically as a boom-bust state.
Even I knew that.
Yeah.
The gold rush comes,
And then it goes.
Silver comes, silver
Then
goes.
it goes, yeah. Home prices skyrocket, then they crash. For lack of better words, marijuana becomes legal. People flock into Colorado. House prices soar. Technology, employment, opportunity.
I think, hasn't Denver been the #1 growing city in America?
Number 2.
Number 2, okay.
Yeah. The only state that outperformed us for appreciation in the last 5 years was Nevada.
Nevada,
Yeah.
okay, which is probably Vegas.
Yeah, probably a lot of it out there, yeah.
So right now is boom time in
It
Denver,
is boom
Colorado.
time, and it's been boom time since probably 2010, 2011. Around 2009, the bottom of the market sort of finished, started seeing some
Well,
appreciation.
you mentioned earlier, 53% growth in 5 years.
Yeah.
That's huge.
It is
I mean, if you
huge.
had $1 million house, you just made $500,000 in 5 years for doing nothing.
Yeah, and think about it like this. So it's really easy to look in the past and go, I woulda, coulda, shoulda.
Yeah.
But it's really scary looking forward and going, why would I do this? Denver especially has been on a boom for the last 7-8 years. At what point does the market top out? Which is why we brought out the Home Safe
Well, and
Equity
which is
Guarantee.
why, unfortunately, we're trying to convince people, let's face it, to at least try and get a mortgage.
Yeah.
And the people who hadn't got a mortgage may not be getting a mortgage because they're scared
Yep.
that you're buying this at the peak of the market. What happens if it claps? I'm going to lose my down payment.
Yep.
I'm going to lose all of that work I put into the house. I
Yep.
put in a new kitchen. I just
Yep.
lost that. And
Yep.
are you trying to tell me, in all seriousness, David, you're trying to tell me that you can protect me from losing my down payment and losing the equity in my house?
Correct. And we can protect up to 100% of it based on today's value, and I'll tell you how. So the actual limit of the policy that covers this, the underlying policy that insures up to 20%, is based off of today's value. So for simple math, if your home was $500,000, 20% of that is $100,000. So how do you protect the other 80%? Well, the market's at maybe or maybe not its peak, close. Is there more appreciation to come? Maybe, but you don't know what's going to happen tomorrow. So even if you only owed $200,000 on your home, well, there's still a differentiator. So we can give you the loan up to 400 grand, even though you may not need the 200 for anything. Insure the 100,000 equity piece, and now your home is insured and protected for full value.
Let's say I've got a $500,000 house. I just did a mortgage with you. I put 5% down, and all of a sudden, you know,
have to sell 3 years from now,
so it's-
and the market's gone down.
that's when
The
this
insurance
that's
kicks
when,
in.
So this is a very real thing.
Oh, yeah.
So that's how you can quantify it. You say, okay, well, you paid X amount of money for this house.
Yes.
You put X amount of money down. You just sold it for this amount, and I'm going to get a check from the insurance company to
Correct.
cover that difference.
Yeah, and here's how it works. Just to make everything a very level, easy playing field, is moderated by the FHFA index. It's
Yeah.
a federal housing index. And let's say today, and I'm going to do round math to make things simple. Let's say today that index was at 100 even.
Right.
And then 3 years from now you lose your job, or 3 years from now you get a job transfer and something's causing you to want to or have to sell that house. If that index has now fallen by 10%,
Right.
or in your case you said you put 5% down, if it's fallen by 5% or more, then when you sell your home, you selling it for fair market value. That $25,000 that you lose because the market has actually taken a hit,
I'm insured against.
you're insured against it. Yeah.
That is amazing. Folks, when I say to you, this is the guy that's done what Uber did to taxi drivers to the mortgage company, I'm not kidding you. This stuff, I've never been excited in mortgages. I think mortgages, I hate to
Yeah,
say
it's
it, not
not-
trying to be offensive,
yeah.
but they're kind of boring. But
Yeah.
this is super exciting. And I know you can't absorb everything that
Sure.
we're talking about. I'm
Sure.
having a hard time absorbing it. I'm sitting here asking questions.
Yeah.
But what you can do is go to the website, usmortgages.com, and you can get a whole bunch more information. You can pick up the phone and talk to either one of the staff or to David himself and really get the lowdown on how you can get in on this business of building equity.
Yeah,
Th- th-
building and protecting. So here's the great part about that is not only are you insured for loss and insured for it for up to 10 years from now, you're also not restricted on gain. So let's say
So I
we're
could-
completely wrong and
Yeah.
there's another 8-year run left in the Colorado housing
right.
market. So you buy it, you're protected, you're insured, you never need it, you've just picked up another 53% equity on your money, you sell, and you're laughing all the way to the
So in
bank.
10 years, you basically doubled your money.
Absolutely.
and
you,
some.
you could,
Now,
absolutely.
and it makes sense. Okay, so the Federal Housing Authority
Mm-hmm.
created this product to encourage people to buy houses, right?
Nope.
Why did they make it?
They didn't make it. That's the index that it's gauged off of. So what happens is that's a federal housing index. So you can look at the median cost price of a home and then you can see where that is. And it doesn't matter whether your home's expensive or moderate. You're still buying at that point where that index is. So then when you sell, if that index is higher and you choose to sell for a loss, that's up to you.
Right.
But if that index is lower, you could actually sell that home and instead of taking the beating because you just sold it for top dollar and top dollar is still less than what you're getting at today, that piece can come back to you. It won't be more than you've got for equity and it won't be more than you've got for down payment because it caps at 20% of the value of your home or your down payment,
Right.
whichever's less. Because
Right.
if you put 5% down, we're not going to insure it for 20. But your full 5% would be insured. If you put 25% down, 20% of it's insured. So you still only have that nominal piece that would be exposed, but it's only exposed because you chose to put more than the minimum down to have insured. So that's okay. I mean, you may want to put 50% down buying your home because you can. Why not take the insurance to cover 20% because it's based on purchase price, not what your loan amount
Now, but does
is.
that add more to my note every month? I mean,
Nope.
because the insurance company that's underwriting this risk, right, must be something in it for them. Correct?
Well, sure, they're getting paid on the insurance. We're absorbing that.
So this is basically just another service for your customers.
Correct.
And you've built a reputation over the last 17 years?
23.
23 years, you build a reputation in this market for being the man, right? David Szymanski, also known as the Shoe Man, baby. The man to write your mortgage is sitting right next to me, whatever kind of mortgage it is. We've got one more thing we're going to talk about real quick when we come back from break. Stay tuned. This is actually probably the most exciting part of the show coming up. But basically, he can get you a loan. If you're going through divorce, he's got a special product for that. He can insure your equity so you can't lose, but you're not protecting them from making. So it's like you're insured against losing, but you can make as much as you like.
Correct.
And we're going to come up next with a way that you can take equity out of your house and have it in a nest egg. What is that product called?
That is called the Emergency Cash Reserve Fund.
Emergency Cash Reserve Fund, coming right up after this message. One, we were talking off camera just when we went to commercial break, and I said, we've got to talk about this.
Yeah.
And there is so much to talk about. He's got so much stuff going on in the mortgage business, but this I want to talk about.
Sure.
And it's called refinancing, or no, what's your name?
Well, the part for the piece you're talking about protecting the equity is the Home Safe Equity Guarantee.
That's what we finished.
The other thing that we were talking about,
Yep.
though, was the Emergency Cash Reserve Fund.
I like the Emergency Cash Reserve
I
Fund. I
know,
don't know,
we
maybe
talked about that.
maybe it's something about me, but I like the fact. Well, explain it first, because I
Okay.
know a little bit about it, which is not really fair. So explain what it is.
Well, most people, and I don't want to just put this as a carte blanche, as a blanket across the board for everybody, because I know that's not the case. But let's say more than 50% of the population doesn't really have a significant nest egg if something were to happen.
Right.
So they have good income, you pay your bills on time, all that
They're
good
2
stuff.
weeks away from being on the street.
Absolutely,
basically.
because what happens, let's say you do have better than the average and you've got 10 grand, 20 grand, 30 grand put aside. Well, look at what your income is. Look at what your bills are. Not just the bills you pay, but
Right.
your total cost of living every month. So that includes gas, insurance, utilities, food, entertainment. Add it all up, look at that number and go, okay, you're a professional, you're in your 50s, you getting to replace your job if something happened to you is much more difficult than the millennial that
Right.
maybe doesn't have a whole
I
lot of
would probably be,
responsibilities, doesn't have the
I
spouse,
have friends of
doesn't
mine that
have
have
the
been
kid.
looking for jobs for months and months
Yes,
and months.
and the more money you make and the higher you've climbed on the ladder, the harder that job is defined.
Right. So you end
So-
up going to taking a job stocking shelves in a grocery store. So you're
We've
making-
seen it. You've seen. How many times have I been to Home Depot and you see a guy that you're like, oh my gosh, I know who this guy is and I know what he used to do. And he's like, hey, this is what happened and this is what I'm doing to get some income in while I'm still looking for a job.
But
That's
meanwhile, he's not
real.
looking for a job
Oh,
because
no,
he's
he's
working.
still learning.
Well, I'm saying he's not
but his
full-time.
income is maybe half or a quarter
Well,
or
I totally agree with
20%
you. I
what it
think
was.
expect the unexpected.
Yes.
I think we should. I know every time I turn around, something unexpected happens.
Yeah.
I don't have a cash
Reserve
fund.
Yeah.
So I'm very interested in this product. The longer I sit here, the more I think I'm going to move to Denver.
Well, Think
Anyway.
about this. Think about this for a second. So, again, we've talked about equity. We've talked about the amount of equity and appreciation Colorado's had.
Right.
But let's say you do fall into that. Let's say you did buy your house 5 years ago or longer, and you're sitting on a big pile
Well, I
of
got
equity.
$100,000 right now. I got $100,000 of equity in my house.
Okay,
And I also need 35 cents to go across the toll.
sure.
So
And guess what happens? So now you've got that equity in your house, and that is real and tangible, but it's
It is right
also perceived.
Right.
Because if you're not selling your house today, you've got 100,000 of equity today based on today's market.
Right.
If tomorrow's market's improved, you may have a little bit more. If tomorrow's market is deteriorated, you may have a little bit less.
I
and
could
so
potentially
then,
be upside down.
that'd probably be a little ways out more than tomorrow, more than next year.
Right.
You'd have to have some significant economic impact. But there's a lot
It
going
happened
on
in
in this world.
2008. In
We got
2008, how many
conflict
people
going
were
on
upside
with
down?
Russia. We got conflict going on with China. We got trade wars going on. We got some real issues.
Yeah.
We got people claiming stock market
Again,
bubble.
expect the unexpected,
Yeah,
right?
and you can't just sit back and go, I've got 200 grand
Okay,
equity in my
okay,
house.
we're
Great.
we're running out of time. So
Okay.
tell me how this works. Okay,
Okay.
so I've got $100,000 of equity in my house. I
Okay.
come to David Szymanski and say, David, I don't want to do anything to money. I just want to have it. I just want to have access
Correct.
to that money if I need it.
Correct. And so what we would do is we would look at your whole profile,
Right.
find the best product for you, get you access so now that equity that's tied up into the house is in your control. Because let's face it, if you miss payments on your mortgage, that servicer is going to take that property back and sell it. So now your perceived equity is gone. You pull that equity out, you control that equity.
I can use that money to pay the mortgage if I have to.
Sure, you could invest that money. There's all kinds of things you could do with that you control instead of having it just in the home.
My $100,000, can I take it all?
No, you're capped at certain percentages. So depending on the value of your property, you're going to be able to borrow up to a maximum of 80 or 85%, and in some unique cases, you can go to 90 and 95.
Well, a lot of it would depend on the appraisal. My particular neighborhood is going through the roof right now.
Yeah.
So I'm saying if I had 150, I could cash out for. If I had $100,000, and folks, you need to listen to this because we are running out of time here. There are so many reasons to contact U.S. Mortgages, but I don't know if you're understanding what we're saying here is that you can have your equity in a bank account in case something goes wrong.
Yeah, and you control it. And what most people fail to realize is when you need the money the most, let's say you did lose a job, let's say you did have an accident, more than likely, you're not going to qualify for the loan at that time because your income may not be there and it may not be stable. And if that happens, you could have $1 million in equity in your house, but if you can't get a loan to access it, the only way you're going to access it is if you're willing to sell that property.
So basically, act before the
Correct.
problem.
Correct.
Be prepared. But this is an age-old thing. I mean, this is how rich people get rich. They plan
Correct.
for the future.
Yes.
And you too could be one of those people that plans for the future. You can pull the equity out, put it in the bank. You don't even have to spend it. If you want to do
Correct.
it, but if you want to do a job to the bathroom or to the kitchen
Yep.
or renovate the place,
Or
you just-
consolidate debt and save hundreds, maybe thousands. You've got
your credit-
options available.
Right.
Mm-hmm.
So, folks, we have run out of time. My cameraman's been doing this for the last 5 minutes. We might have to make this a 1 hour show. I
Yeah.
don't know.
All
But
right.
we've just scratched the surface.
Yeah.
And David, I just want to say thank you so much for coming here. And thank
Yeah.
you for all you do, from what I hear, from all the people we've interviewed, all the testimonials. Thank you really and truly for what you do, not only for regular people, but also for the veterans and for what you do for the community.
Yeah.
I think genuinely, I'm obviously a host of an infomercial, so I would probably say this anyway, but I genuinely believe that David Szymanski is a good guy, and I think if there's anybody in this city that deserves your business, it's this man sitting right here. So please, if you need a mortgage, go to usmortgages.com or call the number on your screen, and thank you so much for watching.